Good morning, traders. My name is Christopher Vecchio, currency strategist with Daily FX. Today is Friday, October 16th, 2015. These are your FX headlines as we turn the page to North America. And this morning, we're already seeing the slight bit of data that's out wash over the market with really not much to do. We had Eurozone CPI this morning out, final readings, nothing changed from the prior, or the expectations rather. And overall, it's more or less a period of dollar digestion this morning after selling off into fresh lows for the month of October and really what would be the lowest levels that we've had since the end of August here. US dollar index has made quite a nice rebound over the last 24 hours. That being said, it's still far too early to determine whether or not this pair is actually bottomed or not here. We were looking for earlier a move back up through 11,966, and we couldn't get a 4-hour close through there. Instead, we're starting to respond to and treat the daily 8 EMA as a little bit more of resistance, not quite getting up there in subsequent rallies. So that's something to keep an eye on. If that becomes a little bit firmer of resistance, that would be a sign this is maybe a weaker market than this bounce is currently indicating. But if we do clear this level, and we can clear the last swing high, that's when we can start to talk about rebounding here within this broader pattern. It's not really a clean pattern or anything that we're too excited about, but in terms of just a general consolidation or thrust in the market, if we're due for a general sideways range or upward motion, then we are at support right here and should be looking for perhaps price to stabilize a little bit. As it were, when we look at what's going on behind the dollar's decline, it's twofold. One, it's a boost in risk appetite, and two, and really because of two, we're seeing that risk appetite and the dollar are moving in different directions, in part to expectations over when the Federal Reserve is going to raise their main rate. Now, when we go back to the beginning of August, and you were to look at what the expectations were for October, there was just short of a 50% chance that the market believed that the Fed would raise rates in October. All right, now if you go to today with this October 28th FOMC meeting barreling towards us, there's only about a 6% chance. Right now, the federal funds futures contracts are pricing in March 2016 as the most likely period for when the Fed will raise rates. And you know what? It's not just there. If you look at Eurodollar options contracts, it looks like they're starting to price in July 2016 as the most likely period for when the Federal Reserve would raise rates. So depending upon what gauge you're using to measure the dollar's interest rate expectations, they have declined pretty precipitously over the last few weeks, and it's gone in tandem with the decline in U.S. economic data. Now today, for U.S. economic data, it's not looking like we're going to have that much really of anything out that's of interesting for traders. Manufacturing and industrial production from the United States, somewhat interesting, but not really considered market moving. We have the preliminary U of Mich confidence today as well. Again, interesting, but how much staying power will that hold over the market remains to be seen. You probably get a few pip reaction, but not much more. So it's really all about digestion of the current moves and consolidation. Eurodollar here is pulling back further, and this pullback looks like it can maybe gain some acceleration now that we've cleared out the former swing low here. Indicators are starting to pull back, however, not yet in bearish territory. Remember, we just had two triangle breakouts this week, so seeing a little bit of a pullback now that we did get up to our level, right? We were looking for a move up towards 114.65 perhaps, and we got there. We've turned around. Now it looks like we need to see if we can stabilize here. Otherwise, Euro, as we've mentioned, reflexively is something that we like to sell rallies in. As the Euro gets stronger, it increases the likelihood that the ECB eases, and given where Eurodollar is at and some of the risk in the market's at, it's clear that the market is gearing up for more easing. So I'll be watching to see if price can stabilize back down here. Its breakout point right near that 34 EMA, 112.71. This really can go down even further, maybe 112.50, before we can actually talk about it losing its uptrend that we've had since the August lows. You look at pound dollar. Pound dollar here is in a little bit of a stall mode as well, reflected by the dollar index. You can take a look at this, and we're back in a familiar resistance zone that's kind of been treating the market as something to trade around the last several months. But right here, trading between 154.20 and about 155.10. We're seeing that right now we're starting to maybe carve out a little bit of a range above a prior swing high, the key reversal area. Indicators in bullish territory right now. Worth some patience here. Not a lot of agreement between, say, the 4-hour, and then you look at the daily just starting to rise back into that bullish territory. You can see how we're getting close to perhaps breaking the downtrend here, but not just yet. Just another degree of patience is required. You look at the last two major components of the dollar index, Aussie dollar and dollar yen. Aussie dollar here after its triangle breakout, right? We had a break in the downtrend from May, symmetrical triangle. Now after the breakout, looks like we're putting in another triangle. Consolidations occurring in the indicators above the respective median lines, signal lines. This looks like there may be some bullish move left to squeeze out of this. And lastly, dollar yen into today. We saw a little bit of a rebound after the move yesterday down to the swing lows that we had from late August. Right now, the goal remains to sell the rally. We have the indicators in counter trend mode, and as it stands, dollar yen trading at 119.13. We're below that supply region, really 119.30, where the market held up as support for quite a while there, going back the last several weeks. You can see here how market was not really keen on putting too many closes below that level. In fact, as soon as price got down there, snapped back into 119, about 25. That should be some resistance, and if not, we get back through there. We want to go back to the breakout level, 119.91. So with dollar yen leaning lower, it really could use some help of equities falling back. Of course, if equities fall back, it's probably going to be a result of some data turning around here. Right now, equities running higher as the dollar declines, generally speaking, the last few days. Seems like the market is pricing in more easing from the Federal Reserve, even if that means they're just not going to be raising rates in 2015, something that's becoming more and more a possibility as we move forward through this first month of the fourth quarter. All right, that's it for me today. I'll be back later on with another video. You can always reach out to me through the Daily FX Real-Time Newsfeed, StockTwits, and Twitter at CVecchioFX. You can always join me daily from 6 to 7 Eastern, 10 to 11 GMT in the Daily FX Live, Daily FX On Demand room, and you could always email me, cvecchio@dailyfx.com. If I don't speak to you before then, good luck trading the rest of today, and of course, have a wonderful weekend.